Really interesting week. I think we're at a really important inflection point in the Australian property market. It's still early in 2024, but what's happening this year is that we're cycling off some trends that we're starting to establish late in 2023. And it's really important that we pick up on these because they're starting to change and they're going to set the tone for what happens for what I believe the beginning of the year. If you missed my update last week, I went through some starting data. I looked at some data last week, particularly around retail sales and how they bounced. And I cautioned and I said, retail sales bounce around. The November retail sales numbers were impacted by a longer than expected Black Friday. And I need to wait and see what happens in December before I can form my view. And this week, I'm starting to see what's happened in December. And it's not good news. I'm going to start off, I'm going to talk in this video about three things. I'm going to talk about the jobs numbers, I'm going to talk about consumer sentiment, and then I'm going to talk about the outlook for interest rates. Really important because the first two things that I talk about impact the third thing. Jobs numbers actually came out after the consumer sentiment numbers, but I'm going to talk about them first because that is, I believe, the single most important thing that's going to drive inflation, that's going to drive interest rates, that's going to drive asset classes, including real estate. The jobs numbers are pretty bad. If we have a look at the unemployment numbers that have come out, jobs data is a little bit confusing if you don't know how to read it because they give you the trend data. But I always look at the seasonally adjusted numbers because they adjust for one-offs, they adjust for timing, calendar dates, and things like that. If we actually go and have a look at what happened in the jobs market in December, we can see that 65,000 jobs were lost. And that's huge. That's a really, really big dip in employment. Now, we've got to keep in mind that we had an RBA increase at the beginning of November. And businesses were looking forward to the Christmas trading period and to this year, 2024, and making plans. And this reaffirms my view that things really started to slow down after that November hike. It was not clear in the Black Friday sales numbers, but I think what the Black Friday sales numbers did is they brought forward the usual Christmas spending. And I think the economy has been struggling ever since late November, early December, and continuing until now. And these job numbers reaffirm that. 65,000 jobs lost. The only reason that the unemployment rate stayed at 3.9% was because the participation rate fell, right? So you had the participation rate come down. Now, the participation rate basically had been edging higher, so it's come back to where it was. But if the participation rate didn't come down, you would have had unemployment rate with a 4 in front of it, not high 3.9s. But for me, I always look at the composition and the net jobs being created and the net jobs being lost. And so this is actually pretty soft. It shows that the economy is starting to trend lower. The unemployment rate is still quite low, but I think we start to see it with a 4 in front of it. I think in the next few months, this trend will continue. And there's no doubt that the February RBA decision is important. But I think businesses are already making decisions. Businesses are already looking forward, and they're not going to really worry about what the RBA says or does because the pain has already been done. The damage has already been done by the RBA, and we're now going to start feeling it. So I think what we start to see is the unemployment rate go into the fours, mid fours to high fours. The RBA starts to get really cold feet. And again, I still think that happens around the middle of the year. I still think that happens. I don't know whether it happens June. I don't know whether it happens September. But I think second half of the year, from the middle of the year onwards, we're going to see ourselves in the mid fours. Commodity prices may come down a little bit because of what's happening in China. And all of a sudden, we've got a big growth problem. Everything that's been holding the economy up starts to soften. If you have a look at the trend in employment, we've peaked. when we're coming off that peak. These numbers I'll leave it for you guys to go through, but basically for me, the number of hours being worked are coming off. They've peaked, and the full-time jobs composition has peaked, and this is it. This is a big, big, big miss, and we need to watch that closely. I'm now going to go and talk about consumer sentiment that kind of works with this. So the consumer confidence numbers that come out do chop and change a lot. They're Westpac numbers, so they're not their survey. It's a Westpac survey. It's very well respected. It's very well established, but it's not official ABS numbers. And consumer confidence dipped in January again. And consumer confidence, when you actually take it holistically, so this is the month-on-month changes, but when you actually have a look at the trend, it shows that consumer confidence is so low that we're now at levels that are similar with other recessions, right? So you don't see it here. I didn't put that up because I wanted to show you how it dipped in January. But consumer sentiment is really, it's at low levels. It continues to fall. And again, I keep referring to that November hike. That November hike was really the nail in the coffin because we're starting to see things come down, things come off. Consumer sentiment did bounce in December, but these numbers tend to lag a little bit. And when people start losing their jobs or hear of their friends and family losing their jobs, this is a little bit of a lagging indicator, and I think you're going to start to see consumer confidence continue to soften over the next few months. So again, it's painting a picture of what's happening with the consumer. The last missing piece is the December retail sales numbers, which I don't have yet, but I'm going to provide them in an update. And now I'm going to go and show you what the markets are pricing in terms of interest rates and how that's going to impact the property market. So this chart here shows what interest rates, what 2-year Aussie government interest rates are trading at in the market. I like to look at this number because it gives us a bit of a indication of where the cash rate could go. These are 2-year rates, so they're not the cash rate. The cash rate is the immediate rate. This is 2 years out. But basically what the market's implying here is that interest rate expectations have been coming off since mid-November. Now, remember, we had that rate hike. 2-year rates went up, but ever since then, this trend has been coming down, and it did dip down, quite hard, below 3.7%. It's bounced a little bit. This does bounce around a little bit because it's the 2-year rate. But what you can see here is that the market's now starting to price in interest rate cuts 2 years out. Now, this isn't a perfect guide. This does fluctuate, as you can see. It is very temperamental, but it's starting to show that the market is looking through and seeing the weakness that we've just spoken about, that we've just discussed, and the implications of that in terms of leading interest rates lower. So in a nutshell, what does this mean for the property market? It means a couple of things. One, on the demand side, it means that the economy is softening. It means that rental growth has probably peaked. Interest rates have no doubt peaked. I've got no doubt in my mind that unless inflation is stubborn for some odd reason, which will be a short-term reason, I think rates have peaked, and I think inflation has peaked, and the weakness in the economy is going to drive inflation lower. So on the demand side, the underlying economy is soften, but the unemployment rate's not at a disastrous level yet. And the second factor in property is not the demand side, it's the supply side. Because supply has been really, really tight, and because, even now the Prime Minister, federally and state, they're coming out and having to shy away from their home building targets, we're not building anywhere near the amount of homes that we need to. And so you've got demand that might benefit from falling rates. You've got supply, which is basically very, very weak, and that has really protected the property market. You've got another element creeping in now, savvy investors that are looking and basically listening to everything that I've just said, and they're seeing it themselves, thinking rates are going to come down towards the end of the year. Maybe it's time to buy a property now. or maybe, I can snag a good deal now because when rates come down and the supply isn't really there, property market's going to keep going higher. That's going to support prices. And I think that's a sentiment that's still small, but that's a sentiment that's building. So I don't think property prices come down even if the jobs market softens because supply is not there. What I'm really watching for is a supply game changer. We didn't get it in 22. We didn't get it in 23. It doesn't seem like we're going to get anything in 2024. If we do, I'll no doubt update. But until then, I think all eyes are on the slowdown in the economy and the impact that has on interest rates, and everyone's going to make up their own decision as to what that means for them. Happy investing. Make sure you subscribe and share this with anyone that you think can benefit from it or that might find it useful.